Welcome to the deep dive. Today, we're tackling something pretty central to long-term financial health, dividend investing.
Yeah, absolutely.
We're digging into your source, Marc Lichtenfeld's Get Rich with Dividends. The plan is simple. Pull out the actionable strategies, how you can use dividend stocks to build wealth, generate income, that kind of thing.
Right. And we want to do it efficiently, give you the core knowledge without sort of drowning you in jargon.
Exactly. Quick, clear insights.
And the book, well, it doesn't pull any punches. It basically says understanding this stuff is like incredibly valuable for your financial future.
Great.
It's all about harnessing those regular cash payouts, and the potential for steady long-term growth by investing in these established dividend-focused companies.
And it's not just any company paying a dividend, right? The book gets more specific.
Oh, yeah, definitely. It goes into the details. We'll look at why dividends are compelling, how to spot these perpetual dividend raisers. That sounds key.
Perpetual dividend raisers. Okay.
Yeah, we'll check out their historical track record and even the kind of mindset you need for this approach.
And you mentioned a system, something about making it manageable.
That's right. The 10-11-12 system. It's presented as a framework, a way to aim for, pretty significant returns and yields without needing to be glued to your screen all day.
Okay, let's start at the beginning then. Why dividend stocks? I mean, honestly, it doesn't sound as flashy as maybe investing in the next big tech thing.
That's fair. It's a common perception. But the book quotes Dr. Jeremy Siegel, who makes a great point. Dividends are tangible, real cash.
Right.
Unlike earnings or revenue figures, which, let's face it, can be fiddled with through accounting or just swing wildly with the market. A dividend payment, that's cash landing in your account. It's direct, it's reliable.
Okay, I get that. There's something solid about seeing that money actually arrive.
It's more than just a feeling, though. The history backs it up. There's research mentioned by Harvey Rubin and Carlos Bath II showing that over the long term, focusing on dividend payers has been a really solid path to financial security. It gives you that consistent income stream and, importantly, one that can actually grow even if the market's having a wobble.
That's compelling. Makes you want to look closer.
Definitely. And check this out. Ed Clissold's research, mentioned in the book, looked at the S&P 500 from 1929 all the way to 2010.
Okay.
If you just looked at the stock price gains, $100 turned into about $5,000. Not bad, right?
Yeah.
But if you reinvested all the dividends along the way, that same $100 grew to over $117,000.
Wow. Okay, hang on. $5,000 versus $117,000.
Yep. The difference is staggering. It's that compounding effect.
That's the snowball effect you hear about. It just keeps feeding itself.
Exactly. It's not just the final number, it's how it gets there. Those dividends buy more shares, which then pay more dividends, buying even more shares. It builds momentum that, say, a bond just can't match.
Right.
But, and this is important, Alexander Green mentions it in the foreword, you can't just chase the highest yield number you see.
The catch.
Yeah, the dividend trap. Some companies might be in trouble financially, but they keep a high dividend going to stop people selling. You've got to be selective. Look at the fundamentals. Cash flow. Is the payout sustainable?
So quality over just quantity of yield. Makes sense.
And don't forget inflation. It just eats away at your buying power over time, doesn't it?
Mm-hmm. Slowly but surely.
Well, companies that keep increasing their dividends help you stay ahead. Your income stream keeps pace, or even outpaces inflation, ideally.
Okay, that brings us back to these perpetual dividend raisers. What's the actual definition there?
It's pretty straightforward. These are companies with a proven long-term track record of increasing their dividend payment every single year.
Every year? Wow.
Yeah, and the book breaks them down. You've got the dividend aristocrats. They're in the S&P 500, 25-plus years of consecutive increases. Then dividend champions, same 25-plus years, but not necessarily S&P 500 members.
Okay, so aristocrats are a subset of champions.
Exactly. Then you step down to dividend achievers or contenders. That's 10 to 24 years of increases. And finally, dividend challengers with 5 to 9 years.
It's like a tier system based on reliability. Any standout examples?
Oh, yeah. Genuine Parts Company, GPC. They've raised their dividend every year since 1956.
56.
Think about that. Recessions, market crashes, wars, they just kept raising the dividend. Their net income in 2011 alone was over $500 million. That says something about stability.
No kidding. That kind of track record really speaks volumes.
It does, and it's not just giants. The book mentions Tompkins Financial Corp, TMP, much smaller, a regional bank, under $500 million market cap. but still a dividend champion, still consistently growing that income for shareholders.
That's good to know. It's not just the megacore.
Right, and actually this is where you as an individual investor might have a bit of an edge.
How so?
Well, some of these smaller, high-quality dividend raisers, they don't trade huge volumes. Big institutions, hedge funds, they might struggle to buy enough shares without moving the price too much.
Ah, liquidity issues for them.
Exactly. But for you, you can often step in and buy these solid, maybe less followed companies more easily.
Interesting advantage. Now, what about yield? Do the longest streaks, the aristocrats, always pay the most?
Generally, no. There's often a trade-off. The aristocrats, the champions, they're seen as safer, more established, so their current yield might be lower.
Oh.
As you look at the contenders or challengers, you might find higher starting yields. Think Atmos Energy, ATO, a contender, or Columbia Sportswear, a challenger. But, their track records are shorter. They haven't necessarily proven themselves through as many tough times, so potentially a bit more risk for that higher yield.
Right, makes sense. And history isn't everything, is it? The book has a warning example.
It does. FNB Corp, FNB, had a fantastic 35-year streak going. Yeah, until 2008, 2009. They froze, then cut the dividend. It's a stark reminder. Past performance is a guide, not a guarantee. You still need to watch the company's health.
Always got to keep an eye on the fundamentals. Okay, let's dig into that past performance more. The book's chapter title is pretty bold. Past performance is no guarantee, but it's pretty darn close. What's the evidence?
Well, it acknowledges the standard disclaimer, the one everyone has to say,
Right.
but then it points to historical data suggesting these dividend raisers haven't just given good returns, they've often done it with less volatility, less risk.
Less risk. How do they measure that?
It mentions the Sharpe ratio. Basically, it measures your return relative to the risk you took. And historically, the S&P Dividend Aristocrat Index has shown a better Sharpe ratio than the main S&P 500.
So better bang for your buck, risk-wise.
Kind of, yeah. Better risk-adjusted returns. You're getting rewarded more for the level of volatility you're accepting.
That sounds like a sweet spot.
It can be. And the book gives great examples. Procter & Gamble, PG. Decades of dividend hikes. If you'd reinvested all along, the income you'd be getting today, based on what you originally put in, would be way, way higher than the current listed yield.
Because your share count just kept growing.
Exactly. Same story with Illinois Toolworks, ITW. Long-term holders who reinvested have seen their annual income from that initial investment just balloon.
Those examples really hit home. Makes the compounding real.
Absolutely. And Coca-Cola, KO, that's an even wilder one. A $10,000 investment back in 1981,
Okay.
with dividends reinvested, would have been worth nearly $1 million by 2011.
Whoa.
And the annual income coming off that by then? Huge. That's the power we're talking about over the long haul.
It's almost hard to believe those numbers. From 10K to $1 million.
It shows how your returns start generating their own returns. It just accelerates. The book even plays out a bear market scenario.
Oh, interesting. What happens then?
Let's say the stock price is falling, but the company keeps raising its dividend. When you reinvest, you're automatically buying more shares at those lower prices.
Dollar cost averaging, essentially.
Sort of turbocharged dollar cost averaging, yeah. So when the market eventually turns, your yield on your original cost can end up being surprisingly high.
So the dividends cushion the fall and set you up for a better recovery.
That's the idea. It acts as a buffer and a wealth builder, even when things look grim. The book also compares dividend stocks to bonds. Treasuries, munis, corporates, even junk bonds.
How do they stack up?
Well, bonds give you fixed income, right? A 6% bond pays 6%.
Right, predictable.
Predictable but static. That 6% bond will still pay 6% in 10 years. But a good dividend growth stock, its dividend could be significantly higher in 10 years, meaning your income stream grows.
Yeah.
The book contrasts a Quest bond example with a hypothetical dividend grower to show that difference in potential income growth.
That's a key difference. Growth potential versus fixed income.
Exactly. And another point the book makes, which might bruise a few egos, is about our ability to consistently pick winning stocks.
Right. Most people think they're above average.
We all do. But the data, S&P data cited in the book, shows most professional fund managers actually fail to beat their benchmark index over time.
Ouch. So even the pros struggle.
They do. So the argument is, if you focus on dividend stocks, the yield itself provides a big chunk of your total return. You don't have to be a stock-picking wizard on price appreciation alone.
The dividend gives you a head start.
Yeah, even if you're just average at picking stocks that go up in price, a solid growing dividend can still lead to really respectable overall results, maybe even better than many pros achieve after their fees.
That's actually quite comforting. Take some pressure off trying to find the next 10 bagger. Okay, let's shift perspective. Why do companies do this? Why go through the trouble of raising dividends year after year? What's in it for them?
Fundamentally, it's about returning capital to the owners, the shareholders.
Yeah.
Simple as that. Especially for mature companies churning out lots of predictable cash flow. Paying dividends is a direct way to share the profits. The book contrasts this with share buybacks.
Right, companies buy back their own stock. How's that different?
Well, buybacks can boost earnings per share, maybe nudge the stock price up, but the decision to actually buy the shares, when, at what price, that's up to management. They might announce a big buyback program, but not fully follow through.
So a dividend feels like more of a solid commitment.
Exactly. Research mentioned in the book suggests dividends often come from companies with more stable, sort of permanent cash flows. Buybacks might be used more when cash flow feels temporary, or maybe management thinks the stock's cheap.
Interesting distinction.
So, a long history of raising dividends signals management's confidence in the long-term health and cash generation of the business.
And the book mentions something about it becoming part of the company's identity.
Yeah, it's a great point. Like, just as a person has an identity, some companies build their reputation around being reliable dividend payers. Think Abbott Labs over 50 years of increases. That's not just finance, it's part of their corporate DNA, how they talk to investors.
So it attracts a certain kind of shareholder, long-term, income-focused people.
Precisely. The book quotes Thomas Faust, former CEO of Eaton Vance, saying that dividends are crucial for their investors and that a strong dividend history likely boosts the company's overall stock valuation.
So it's good PR and good for the stock price, potentially.
Absolutely. Happy shareholders are good shareholders. Unhappy ones. They can make noise, push for change. Sometimes activist investors get involved specifically to influence dividend policies.
Right.
And there's another angle, signaling.
Signaling what?
Management's confidence. Research, like from Asquith and Mullins, shows that when companies start paying dividends or increase them, their stock often gets a boost. Even if earnings news isn't great, a dividend hike sends a message.
That message.
We're confident about the future. We expect enough cash flow to keep this up and grow it. It's a tangible signal of optimism that words alone might not convey.
Actions speak louder than words. Makes sense. Okay, we've got the why and the what. Now this next chapter title, Get Rich with Boring Dividend Stocks. Snooze Your Way to Millions. I like the sound of that.
Haha, yeah, it's catchy. The core idea is just hammering home that compounding power again. Reinvesting dividends, even from seemingly boring, steady companies, can build serious wealth.
How does it illustrate that?
There's a table, 5.2, showing different scenarios starting yield, dividend growth, stock price growth. What jumps out is that even with just okay stock price gains, if you have decent dividend growth and reinvest, the returns get huge over time.
Give me an example.
Okay, one scenario shows a stock with a good yield and steady dividend growth. After a couple of decades, your return on the original money invested could be over 340%, even if the stock price itself didn't go wild. It's the dividends doing the heavy lifting through reinvestment.
So the boring companies can be the hidden gems for long-term wealth.
Exactly, and it's backed by research. The book mentions a Harvard study Baker, Bradley, and Wergler. They looked at 1968 to 2002, and guess what? Portfolios of low volatility, low beta stocks actually delivered high average returns and had smaller losses during downturns.
Wait, low volatility gave high returns? Isn't it supposed to be the other way around? High risk, high return?
That's the conventional wisdom, yeah.
Yeah.
But this study and others suggest maybe not always. These boring dividend payers often are low beta stocks less jumpy than the overall market.
And the book lists some examples.
Yep. Table 5.3 shows some aristocrats and champions with betas below 1, meaning less volatile than the S&P 500. The point is, consistent, steady returns, even if they don't look amazing year to year, add up massively over the long run.
Like the tortoise beating the hare.
Pretty much. The book shows how $100,000 earning an average 13% total return per year, which is achievable with good dividend stocks and reinvestment, could hit $1 million in under 19 years.
Wow, that puts it in perspective. And avoids the fees of managed funds, right?
Big time. The book references John Bogle, the Vanguard founder, on how fund fees just eat away at your returns. Compounding works against you with fees.
Yeah.
There's even a table showing potential fee savings over 20 years by holding individual dividend stocks versus a typical mutual fund. It can be tens, even hundreds of thousands of dollars saved money that stays working for you.
Okay, so boring is beautiful for long-term compounding. But what if you need more income now? The next chapter talks about higher yields. What else is out there?
Right. It explores other income options beyond just common stocks, things like closed-end funds, CEFs, REITs, BDCs, MLPs, and preferred stock. They often offer higher yields, but they come with different rules and risks.
Okay, let's break those down. Closed-end funds. How are they different from regular mutual funds?
Okay, so regular mutual funds create or redeem shares based on demand.
Mhm.
CEFs, they have a fixed number of shares, and they trade on exchanges like stocks.
So their price can fluctuate based on market sentiment.
Exactly. This means a CEF can trade at a discount to its net asset value, NAV, the actual value of everything it holds, or at a premium. The book uses examples like Central Gold Trust and Liberty All-Star Growth Fund to show how the market price can detach from the underlying asset value. You're buying the fund's assets, but also the market's mood about that fund.
Gotcha. So you can buy assets for less than they're worth or pay more. What about REITs?
Real estate investment trusts. They own income-producing real estate malls, offices, apartments. The key thing is they have to pay out most of their taxable income as dividends. That usually means higher yields than typical stocks.
Okay. And MLPs, master limited partnerships, they always sound complex.
They can be, especially tax-wise. They're often in energy infrastructure, pipelines, storage. The big thing is return of capital.
Alternative capital.
Yeah. Part of the distribution you get might not be taxed as income that year. Instead, it lowers your cost basis. So you defer the tax until you sell. It's a potential tax advantage, but it adds complexity at tax time.
Right. K-1 forms and all that. BDCs, business development corporations.
These invest in small and medium-sized private companies, providing debt or equity. It's a way for you, the individual investor, to get exposure to private equity, basically. Often pay pretty good yields. Main Street Capital, Maine, is mentioned as an example.
It's interesting. Access to private markets.
Hmm.
And finally, preferred stock.
Think of it as a hybrid between stocks and bonds. Pays a fixed dividend, usually. Ranks higher than common stock if the company goes bust, but below bonds.
So safer than common, less safe than bonds.
Generally, yeah. And they usually don't have voting rights. The book notes many are issued by financial companies like the MetLife Preferreds mentioned.
So a whole menu of higher yield options, but each with its own flavor, its own risks. Diversification seems key here too.
Absolutely crucial. Even within income investing, don't put all your eggs in one basket. Mix it up. Some traditional dividend growers, maybe some REITs for real estate exposure, maybe some BDCs or preferreds if they fit your risk tolerance. Spread it across different sectors too.
Okay, that makes sense. So we've covered the why and the what. Let's get practical. How do you actually build a dividend portfolio?
Right. First thing the book stresses, think long term. Dividend investing isn't a get-rich-quick scheme. You need a horizon of, ideally, more than 3 years.
Patience is key.
Definitely. And you need to decide, are you taking the dividends as income now or reinvesting for future growth? That shapes your whole approach.
And don't chase payment dates.
Yeah, the book advises against trying to build a portfolio just to get a check every month or whatever. Focus on the quality of the company and its dividend growth potential first. The payment schedule is secondary.
Okay. So how do you judge that quality? What metrics matter?
Two big ones, dividend yield and payout ratio. Yield is simple. Annual dividend divided by stock price tells you the current income percentage.
Right.
Payout ratio is really important. It's the percentage of earnings, or better yet, cash flow, that the company is paying out as dividends. The book uses Meredith Core, MDP, to show the calculation with net income, but emphasizes using cash flow is more telling.
Why cash flow?
Because net income can have all sorts of accounting stuff in it. Cash flow is, well, the actual cash coming in the door. A lower payout ratio, especially based on cash flow, means the dividend is safer, more sustainable, and there's more room for future increases. It's like the restaurant owner example in the book, profit on paper versus actual cash in the till.
Gotcha. Lower payout ratio, bigger safety cushion. What else?
Look at the dividend growth rate. How consistently and by how much has the company raised its dividend historically? Brady Core, BRC, is used as an example for calculating that average growth. Are the increases consistent? Are there occasional special dividends, like the American Eagle Outfitters, AEO, one mentioned?
So history matters, but focused on the growth trend.
Exactly. And it ties back to Warren Buffett's rules mentioned in the book. Rule #1, don't lose money. Rule #2, don't forget rule #1.
Classic.
For dividend investors, that means focusing on quality companies that not only pay but consistently grow their dividends. That helps protect your principal and keeps the compounding engine running.
Okay, that leads us to the system itself, the 10, 11, 12 system. Break it down for us.
All right, it's a framework, a target. Aim for an average 10% dividend growth rate across your portfolio each year.
10% growth.
The idea is if you achieve that, you could potentially get an 11% yield on your original cost within about 10 years.
11% yield on cost.
And the ultimate goal is to target an average total return that's stock appreciation plus dividends of 12% or more per year over the long run.
10, 11, 12. Ambitious numbers. What's it based on?
It uses historical stock market appreciation averages, around 7.5% or so, as a baseline assumption for the stock price part. But the book is clear. These are averages, guides. Reality will vary wildly year to year. It even shows scenarios with lower market returns. The key is the potential based on historical trends and the power of dividend growth.
So, not a guarantee, but a target to shoot for based on history. How do you pick stocks for it?
Focus on a reasonable starting yield and, crucially, that sustainable payout ratio we talked about. Don't get too hung up on hitting exactly 10% growth right away. Safety and current yield matter. The book has loads of tables, 8.3 to 8.13, showing potential outcomes with different starting yields and growth rates. They show you can still do very well even if growth is a bit under 10%, especially with reinvestment.
And DRPs help with that reinvestment. Dividend reinvestment plans.
Yeah, they're a great tool. Automatically reinvest dividends, often commission-free. Some companies, like Aqua America, WTR mentioned, even offer a small discount on the shares bought through the DRP.
Free money, basically.
A little bit, yeah. The downside. If you own lots of stocks, managing dozens of separate DRP accounts can be a pain administratively. Some people prefer the simplicity of reinvesting through their main brokerage account. Trade-offs.
Okay. The book also mentions options. Selling covered calls.
Briefly, yeah. It's a strategy to generate extra income. You own the stock, and you sell someone the right to buy it from you at a set price, strike price, by a certain date. You collect a premium for selling that right.
Sounds like extra income, but what's the catch?
The catch is if the stock price shoots up past your strike price, you might have to sell your shares, potentially missing out on bigger gains. So it's maybe better if current income is your main goal, rather than maximizing long-term growth. Selling puts is also mentioned, but noted as generally riskier.
Right. What about looking overseas for dividends?
Foreign stocks, especially emerging markets, can sometimes offer higher yields. But the book adds a note of caution.
Which is?
Currency fluctuations. If the dollar strengthens, those foreign dividends are worth less when converted back. Holding ADR's American depository receipts introduces that currency risk. Plus, dividend policies might be less consistent overseas. Finding true perpetual dividend raisers internationally can be harder. So, while international diversification is good overall, maybe be more cautious relying on them for core dividend growth.
Makes sense. And finally, taxes. The unavoidable topic. How do dividends get taxed?
Generally, qualified dividends from U.S. companies get favorable tax treatment, currently 15% for most people, though rates can change. Foreign dividends might have foreign taxes withheld, but you can often get a U.S. tax credit for that.
Okay.
But the big point the book makes is using tax-advantaged accounts. IRAs, traditional or Roth 529 plans for education. Holding your dividend stocks in these accounts lets the dividends compound tax-free or tax-deferred year after year. That makes a massive difference to long-term growth.
Huge advantage.
Absolutely. But, as always, taxes are complex. The book strongly advises talking to a tax pro for personalized advice.
Definitely good advice. Wow, okay, we have covered a lot of ground for Get Rich with Dividends. If you had to boil it down, what's the single biggest takeaway for someone listening?
I think it's that a long-term strategy focused on quality companies that consistently raise their dividends, these perpetual dividend raisers, combined with the discipline of reinvestment, possibly guided by something like the 10, 11, 12 system. Well, it's just a historically proven, powerful path to building wealth and generating income over time. It works.
It's about understanding it, but then, crucially, actually doing it.
Yeah.
Consistently.
Exactly. Knowledge is great, but action is what builds wealth. The book really pushes you to implement these ideas. And if you want more, the website getrichwithdividends.com has calculators, articles, newsletter info, stuff like that.
Good resource. And I like how the author ends inviting success stories later. It really reinforces that long-term view, doesn't it? Building something not just for you, but maybe for the next generation too. Thanks so much for walking us through all this.
My pleasure. It's powerful stuff.
It really is. And perhaps the final thought for you, the listener, is about that very discipline we mentioned. In a world obsessed with quick fixes and instant results, does the patient, steady approach of dividend growth investing hold a unique power, not just financially, but maybe even psychologically? Something to think about.